23-2 distribution of net income and owner's equity statements. We have two objectives. You need to be able to prepare a distribution of net income statement for a partnership, and you need to be able to prepare an owner's equity statement for a partnership. So a distribution of net income statement is a partnership financial statement that shows the net income or the net loss and how it's distributed to the partners. This is an example of our distribution of net income statement. So notice we always start with a heading, who, what, and when. Must Have Gadgets is our business name. We are creating a distribution of net income statement, and then the date, the when, is going to be 4-month ended January 31st. Okay, next thing that we're going to do is we're going to name our partners. So we're going to name our first partner, Sarah Hatcher. And we're also going to name their share of the net income. So in this case, notice that she has a 50% of the net income. So we would have to know what the net income is to figure out 50%, which would be the $7,862.50. Then we're going to name the second partner, Parker O'Reilly. He also has 50% of the net income, which in this case is the same amount, $7,862.50. And then the last thing that we are going to do is we are going to add those two up to make sure that we have the correct net income. So net income, and that total is $15,725. So this needs to equal what we really have as our net income. Okay, this is showing us the distribution of net income statement that with unequal distribution. So we still have our heading, we still have our two different partners. However, notice that Ling Wang has 70% of the net income, so $47,250, and then Lucas only has 30% of the net income, so that's $20,250. Both of those added together will equal our total net income. Okay, next, a financial statement that summarizes the changes in owner's equity during a fiscal period is called our owner's equity statement. Business owners can review an owner's equity statement to determine if owner's equity is increasing or decreasing, and then what's causing that change. It does give us some factors that can change our owner's equity. So if we have like additional investments or withdrawals, or net income and net loss, that would be something that would change our owner's equity. Information that's obtained from each partner's capital and drawing account. We need to have the beginning capital amount, any additional investments that are made during that fiscal period, and then each partner's withdrawal of assets during the fiscal period. What they're showing us here is our partner's capital and drawing account. So here's Sarah Hatcher's capital account and her drawing account. Here's Parker O'Reilly's capital account and drawing account. Here is our owner's equity statement then. Again, we start with our heading, who, what, when. So this time we're creating an owner's equity statement. We are going to list our first partner. Again, that's Sarah Hatcher. And then we're going to list her information that we have. So we want to look at the capital first on January 1st that she had, then her share of the net income that we figured out in the last statement, then any withdrawals that she's made, so her drawing account, and then we're going to take these two numbers subtracted. That will give us her net increase in capital. So, excuse me, then her ending capital is just taking her beginning capital plus her net increase, and that gives us our ending capital for the first partner. Then we're going to do the same thing for the second partner. So Parker O'Reilly, we have his beginning capital, we have his share of the net income, we also have how much money he took out in drawing to get our net increase in capital, and then finally our ending capital for Parker O'Reilly. We would then add those two numbers together to get our total owner's equity. This example is just showing us our owner's equity statement with an additional investment and then a net loss. So when we look at this, we have Marcus Jensen. Here's our beginning capital. He also made an additional investment. So during that fiscal period, he invested more money. So now his total of capital is 1,960. Then we see he also had a net loss. So here's his net loss and his withdrawals. Notice on this one, we added those numbers together because both of those numbers would decrease his capital. So it says net decrease in capital instead of net increase. And then now what he's left with in his capital. And then the same thing that they did for Emma Johansson. She did not have, oh, nope, she did have the additional investment, share of net loss, plus withdrawals, yeah. Okay, a balance sheet for a partnership is not too new. The only thing that will be different is our owner's equity section. And so here we have our Sarah Hatchett capital and then our Parker O'Reilly capital. Okay, and then total owner's equity. So adding those two together. And then they simply added the liabilities and the owner's equity. Remember, with a balance sheet, we are showing that assets equal liabilities plus owner's equity. So over on this side would be where we would see our assets section, and they had that taken off. To get the capital numbers here, we got those numbers from the owner's equity statement that we just got done creating. So audit your understanding. Question number 1. What information used to prepare an owner's equity statement is obtained from the distribution of net income statement? Each partner share of net income or a net loss. Number 2, what information used to prepare an owner's equity statement is obtained from the partner's capital and drawing accounts? We need to know the beginning capital amount. We need to know if there was any additional investments during the fiscal period. And then we also need to know how much the partner withdrew during the fiscal period. Last question, number 3. What is the procedure for calculating an owner's end of the year capital? To compute the ending capital, we would take our share of net income less withdrawals, and that's going to equal the net increase in capital. Then we would take the beginning capital plus the net increase in capital. That would equal then the ending capital. Okay, you can now go on to the 23-2, work together.